If you've ever been told that you make too much money to contribute to a Roth IRA, well, that's only half the story. Because there is a completely legal strategy, often used by high earners, business owners, and even financial professionals, that allows you to fund a Roth IRA anyways, even if you're above that income threshold. And it's called the Backdoor Roth IRA, or Backdoor Roth strategy. But here's the problem. Most people either do it wrong, they don't understand the tax consequences, or they accidentally create a tax bill they didn't expect. So in this video here, I'm going to walk you through exactly how the Backdoor Roth works, who should use it, the biggest mistakes to avoid, and even how to do it correctly step by step. Before we dive in though, a quick introduction so you know who I am. Hey everyone, my name is Faustino Munoz and I'm a financial advisor. I hold the Certified Financial Planner, or CFP designation, along with the Behavioral Financial Advisor, or BFA certification. And in my day-to-day work, I help individuals and families to make smart, tax-efficient decisions with retirement and investment strategies, especially when things start to get more complex. And the Backdoor Roth IRA is one of those strategies that I help employ, and it sounds simple on the surface, but it can have real tax consequences if it's not done correctly. So my goal is to break it down clearly to help you understand whether it actually makes sense for you and your situation. Let's start first with the basics. A Roth IRA is one of the most powerful retirement tools available. With it, your money can grow tax-free, your withdrawals in retirement are tax-free, and there are no required minimum distributions during your lifetime. But there's a catch. There are income limits to participate. A Roth IRA is basically the IRS giving you a gift, which is exactly why they don't let everyone participate. If your income is above certain thresholds, you can't contribute. So, Congress created a workaround by allowing contributions to a traditional IRA and then conversions from that traditional IRA to a Roth IRA. Put those two things together and poof, you get the Backdoor Roth strategy. Let's walk a simple step-by-step of how this works and how to do it. Step 1, contribute to a traditional IRA. Even if your income is too high for a Roth IRA, you can still contribute to a traditional one. One important note, however, is that this contribution or these contributions are typically non-deductible, especially if your income is higher, meaning you're contributing after tax or already taxed dollars. Then step 2 would be to convert that traditional IRA or dollars to a Roth IRA. Once the money's in the traditional IRA, you convert it to a Roth IRA right away. If you convert quickly, even the next day, before it's had a chance to grow, then the tax impact is typically zero or close to it. We'll come back later on why timing is important. But since you've already paid taxes on the contribution, in most cases then the conversion is either tax-free or has minimal tax impact. The third step then is to let it grow tax-free. See, now that your money is in the Roth IRA, it has the opportunity for tax-free growth, tax-free withdrawals, and that's the entire strategy right there. Now, it's simple in theory, but there are a few major complications and common mistakes when it comes to using this strategy in your life. The pro-rata rule. See, this is where most people get it wrong. The IRS doesn't let you just isolate that one non-deductible contribution and convert it cleanly. Instead, they look at all of your traditional IRA money combined. This, again, is called the pro-rata rule. What does this mean, though? How does it actually get played out? Well, if you have pre-tax IRA money, like an old rollover IRA, and after-tax contributions, then the IRS treats your conversion as a mix of both those dollars. Let's figure out an example here. For example, let's say that you have $90,000 in pre-tax IRA money, and then you've got $10,000 in after-tax IRA contributions. If you convert $10,000, Only 10% of that is tax-free. The other 90% is taxable. That right there is a surprise tax bill for a lot of people. In other words, you thought you were doing everything right, and then the IRS just handed you a huge tax bill you were not expecting. It can be quite the surprise. So the key takeaway here would be that if you have an existing IRA or existing IRA balances, the backdoor Roth becomes much more complicated and potentially can be less attractive based on your situation. How do you avoid or get around the pro-rata problem? Well, there's a few ways to work around it, and each one requires planning. Option 1 would be to roll your IRA into a 401k. If your employer allows it, you can roll pre-tax IRA money into a 401k. Why this works is because 401ks are not included in the pro-rata calculation. This effectively clears the deck so that your backdoor Roth conversion can then be mostly tax-free. Then the second option that would be available to you would be just to convert everything. You could convert your entire IRA balance over to that Roth IRA then. Now, there are downsides to this, of course, being that this can trigger a larger tax bill up front. But then the other side of that coin, the upside, is that you would move everything into that tax-free growth bucket moving forward. Then kind of the next option, the third option available to you would be kind of just to skip the strategy. In some cases, it may make more sense to just use a taxable brokerage account, or maybe it's more sensible to focus on other tax strategies for you in your life. See, one note is that not every strategy fits every situation. There are some very common mistakes. Some of the biggest mistakes that I see when it comes to this strategy is forgetting about other IRAs. People think that they're starting fresh, but they may have old IRA balances sitting somewhere with an old custodian or an old broker. Another one is maybe waiting too long to convert those dollars from traditional to a Roth. See, again, if your contribution grows before the conversion, then that growth becomes taxable. For example, if you contribute, let's say $7,000 in January, and you wait until December to convert those dollars, then that money has maybe grown to $8,000. Well, then that $1,000 of growth is now taxable. So it's a best practice to usually convert quickly when it comes to this strategy. Another one is not filing Form 8606. See, this form tracks your after-tax contributions. It has to be filled out every year that you make a non-deductible contribution. If you do not file it, you could end up paying taxes twice on the same dollar, twice on that same money. Another common mistake is doing it without a plan. See, this backdoor Roth strategy, it's not just a one-time move, but it should fit into your overall tax strategy, your overall financial plan, into your retirement income plan, and your future withdrawal strategy. So who should use this backdoor Roth IRA? Who is this actually for? Who can actually employ this method? Well, the backdoor Roth tends to make the most sense for high income earners that are above the Roth IRA limits, or people who expect higher taxes in the future. Maybe even those who want more tax-free income in retirement. Now, on the other side of that coin, people that it may not make sense for are individuals with large pre-tax IRA balances, or those who expect that their tax rate in retirement will be lower than it is today, because in that case, paying taxes now doesn't really save you much. Or even those that need liquidity in the short term, this may not be a suitable recommendation for you. So today, if you're considering a backdoor Roth, or you're just not sure if you've done it correctly, that's something that you want to make sure to look into and get right the first time. You can use the link in the description below to schedule a call and a time with me. We'll walk through your specific situation to see if this strategy actually makes sense for you. And if you found this video and this time helpful, please make sure to like and subscribe, because I break down strategies like this every week so that you can make smarter financial decisions with confidence.